Hey folks, good afternoon. It is Tuesday, 4 o'clock. And once again, we get together to talk a little bit about charts and a little bit about what's going on market-wise. We're now, 3 weeks beyond the election in the US, and lots of things playing out in the market. Last night, we had a little surprise from the Trump camp talking about potentially 25% tariffs on day one on Canadian goods and Mexican goods coming in. So these are the things that we're going to get used to. Things are a little bit unconventional, and so of course today we had some folks asking us what that might mean in our local market and so on. So we'll touch on that today. I asked Amit Joshi to jump in today, and we're going to talk a little bit about that, and then we're going to talk about the progression of some of the key themes that we've been focused on market-wise to see what, if anything's changing. Talk a little bit about how we are positioned, and as always, try to be transparent about the way we make our decisions and what that means in portfolios. So without any sort of further ado, just to jump right in, we think we started a structural bull market in 2013 when we exceeded the highs from 2000, and we've been working our way higher ever since. This is under a little bit more of the microscope, 2013 present. This is the bear market we went through 2022 and into January of 24, and ultimately made a new high. So we're up 5.4% on the month of November. As you'll remember, our sense was that likely we were going to finish the year reasonably strong, and markets certainly appear to be going down that path. Now, the S&P 500 doesn't always tell us everything. We like to look sort of under the covers to see what's what. But the net of it is, market's been rallying now 141 months, still well shy of what we saw in the 80s and 90s, just about 220 months, and certainly from a percentage point perspective, low. So we do think that there's some room to go. When we look at the S&P over the last year or 2 years, we bottomed in October 22. We've made a series of higher lows along the way, but basically stayed above the long-term moving averages. And we continue to be above the 200-day, the 50-day, the 21-day, and the 8-day moving average. We've made a new 52-week high over the past week. Yesterday and actually today wound up on the day, so this probably understates just by a little, but that's certainly constructive. When we look at the NASDAQ 100, about 2 weeks ago we did make a new high. We have not made a new high since. Relative strength has been a little bit weaker here, but there's some good stocks and some not so good stocks. When I look at the equal weight S&P 500, so giving every single security a single vote, worth the same. Again, this week, it's a weekly chart, made a new 52-week high, which is great because it means that the average stock is participating. When we look at the mid caps and the small caps, we've talked over the last few weeks the concept that you don't get toppy in a market until you start to see the percent of stocks trading above the 200-day moving average really start to fail, and certainly no sign here. In fact, as the mid-cap index made a new high, the percent of stock trading above the 200-day moving average is getting firmer. Russell 2000 yesterday was 0.3 away from making a new high after 765 days. So this chart from my friends at Strategas. And you'll note that when you go a long period of time without making a new high, ultimately then you have a pretty good resulting rally. And so with the Russell 2000 small caps just making a new high, probably pretty bullish there. This is the IWM, that's the Russell 2000 ETF, compared to the NASDAQ 100, which of course includes that Magnificent Seven. You can see since the month of June, a significant improvement in relative price performance. So we really like that. We like that because some of the themes that we've been focused on are more cyclical by nature. And as we highlighted once before, the Russell 2000, the small cap index is made up about 80% of economically cyclical companies. So when small caps start to do a little bit better, it generally points to the fact that people are making a bet the economy is likely to improve. That leads us to the value line geometric index, 2,900 companies equally weighted. This truly is the average US stock. And you can see this most recent month, we've had a blast off out of a range it's been in for the last 3 years. And in fact, really since 2020, it's just started to come out of a very long sideways range that dates back to 1998. That is very bullish because as we looked at the chart of the S&P 500 back over the last 100 years at the first slide in the deck, when you break out of a long sideways range and start moving higher, generally it means you are at the beginning of a long expansion. Now, that's important because the biggest stocks in the US have become quite extended versus global stocks. And we've talked about the fact that the Nikkei 225, has been waking up over the last couple of years, had a few months here sideways. That's okay. It's good to see some consolidation. We'll watch for this to break out higher. India, certainly has pulled back, but we think ultimately long-term looks constructive. This is what happens in a market when a new leader is brought in and decides to cut significant components of the government out of the equation. You can see the market in Argentina, after struggling for a long time, has absolutely blasted off over the last 18 months. I think that's worth watching. If we have some sort of disruptive cutting in the US government, I think that'll bring out lots of people who are upset. But the fact is probably there's a lot of waste, and we'll be interested to see how markets respond to that activity. When we look around the world, the average country has 42% of stocks in uptrends. You can see some global global markets have seen some contraction in breadth. I think that probably is a little bit of investor fear of trade retaliation. We're going to have to watch that. Canada, US, solidly positive. Japan positive, some Latin America positive, but we are watching that as a sign of change. So the TSX, this is the TSX including today. This is a very long-term chart. TSX actually wound up on the day. No, sorry, down 0.02 of 1%. Now, if somebody had said that there would be a threat, that there would be a 25% tariff on all Canadian goods being exported to the US, my guess would have been that you might have had a more rambunctious result than that. But as it turns out, market has been pretty calm today in the face of that. We talked about it this morning on morning meeting, and Amit brought a couple of interesting charts I thought were worth discussing. So Amit Joshi's going to join us today. Clearly the stock market doesn't represent, purely the Canadian economy. A lot of companies, multinational companies by nature, not everybody is exporting stuff. Amit, why don't you give us your thoughts on some of the things that we talked about this morning?
Yeah, thanks, Dave. Appreciate it. I guess it wouldn't be a Trump presidency if you didn't have some tweets that disrupt your morning. So I think it's something we'll have to remind ourselves of and pay attention to. But yeah, we discussed many kind of aspects or sectors of the Canadian market that would be impacted. Dave, I think if you flip to the next chart, we have one there. This is kind of the major exports to the US. As you can see, energy, the largest of those. We'll talk about energy a bit later. I think it's a bit more nuanced. But the auto sector is one that's obviously impacted. It's the second largest. It's a bit harder to quantify the actual level of tariffs or the impacts that we could see, just given how integrated these supply chains are. I think the stat is that certain parts, auto parts, actually cross the border about 7 times before actually being put into the cars that they're for. So it's hard to judge. There are certain parts of the market that will be more prone to the tariffs, and we've seen this in the past, specifically consumer goods. It's actually a sector we don't have much exposure to in our portfolios, but companies such as Saputo, who export a lot of dairy products to the U.S., are definitely a company that could see some impact from tariffs. Same with Maple Leaf Foods, exporting meat and poultry products to the US. So we could definitely see some impacts there as well. Lumber in general is a sector that we've seen continuously be hit by tariffs. So nothing new there in that sense. Um, for us, our largest exposures have been within financials and industrials. Specifically, our exposure to the industrials is through Canadian companies that offer engineering services in the US. So not really industrials that you would see impacted by tariffs themselves. And then financials, many of the major banks, we don't own Bank of Montreal or TD Bank at this point. They do have the largest exposure to the US. However, for them, a stronger US dollar relative to the Canadian dollar is actually a benefit as they would translate that to their financial statements. Banks that we do own, such as Royal Bank and CIBC, do have some exposure to the US, which would also be a benefit. It's a similar kind of exposure to the life insurance companies, such as Sun Life and Manulife, where we do have some exposure.
But certainly no stuff crossing the border on those in those businesses.
Exactly, exactly. And where we did see a lot of the pain today were some industrials that you are seeing products that are crossing the border. Companies such as Bombardier that do business jets, and a lot of those are exported to the US, or BRP, which has Sea-Doos and Ski-Doos and other recreational machines that are exported into the US as well.
Yeah. So that consumer goods sector, $62 billion in trade, that is one that you would want to watch. Now, for those that have been on the webcast, they know our consumer discretionary exposure is about 2% firm assets. We've been staying away from consumer in general. We do have lots of energy, and that brings up that topic. I mean, Amit, realistically, let's talk about trade in energy to the U.S.
Yeah, so this is one that's it's a bit of a head scratcher here from Trump, given how large of Canada's energy exports are to the U.S. The U.S. Imports the equivalent of 8 million barrels of a day of oil for energy, and half of that, about 4 million barrels, comes from Canada itself. The way refineries in the US are set up, they're set up to use heavy crude oil from Canada. That's about 3 million barrels a day on average. This is infrastructure that cannot just be replaced overnight. And, just as recently as last week, Trump was actually tweeting about reviving the Keystone XL pipeline that would take oil from Canada into the US itself. So it's a bit of a head scratcher. When you look at the magnitude of the exports of energy of oil from Canada to the US, this isn't something that can be changed overnight. So, we don't want to take light of the situation, but this is somewhere that we do think that there would be some exemptions that were made from potential tariffs, as the
We
US's
know.
energy security is in question.
Right. We know Donald Trump loves a headline, but it would be hard pressed to see a case where they would consider putting a tariff on Canadian
Definitely.
energy, especially, given, all of the delivery mechanism for energy in the supply chain and how it works down in the US, really virtually impossible to replace, especially for the refineries that need the heavy crude.
Yeah, and I think you take a look at this graphic here, and you see how complicated and complex this infrastructure is. This is years and years to replace this infrastructure, millions, if not billions of dollars spent to replace this infrastructure. It's
Yeah.
it's, it's not
Yeah.
easy to do.
Yeah. So realistically, our take on it, auto parts highly unlikely to be part of this tariff regime if in fact it gets put into place. Certainly, it's a threat, and it's certainly he's using tariffs as a weapon to say, look, make sure that your borders are secure, make sure we're not getting fentanyl sent to the U.S. But realistically, he's not going to do things that are going to significantly harm the U.S. economy. Energy would be one, auto parts would be another. I think that you probably have to be careful on consumer goods. You probably have to be careful on some industrial goods. But really, that would be the focus as far as we can see. And going through our portfolio, really outside of energy, really very little that we think could be negatively impacted in this format. So thanks very much, Amit.
No problem at
Moving
all.
on, to fixed income. Certainly, this 10-year yields continue to be stubbornly high. They started moving higher in 2020. We've made a series of higher lows. Recently, we made another higher low. If you look at the long end of the U.S. Treasury bond market, over the last 4.5 years, the long end of the Treasury bond is down 48%. So barely off the carpet from the lows in October of 2023. It's obviously the longest bear market in bonds in the last 45 years. I would have to think that bond investors who have stayed there are getting pretty darn frustrated. Realistically, bonds are a great hedge in a disinflationary world where the risk is that prices are falling. Getting a fixed income in a world where prices are falling, that's a great investment. But we know that when inflation gets going, and these are each of the last inflationary waves we have seen, after an initial first pullback, you are likely to get a second wave. Now, we've seen inflation numbers come in hot in the UK. We've seen inflation numbers come in warm in Europe. We've seen inflation data come in warm in Japan. We've seen inflation data come in warm in South American countries. And in fact, the inflation data last month in the US came in above 3%. It does not appear that it's going straight to 2% either. So this is something that we've been keeping in mind in our income strategy. Clearly, stocks do better than bonds in an inflationary environment, and that is the case. This is the S&P versus the 10-year bond ETF. Clearly, dividend growth stocks are outperforming since the turn in interest rates. And again, we put in another relative high this week. And clearly, dividend growers relative to high dividend payers, which we call bond proxies, continue to outperform as well. So in the income strategy, it continues to kind of bump along. It's up about 22.7% on the year. In fact, outperforming the equally weighted S&P and certainly the U.S. bond market. We think this is the right spot, and there's nothing changing here. We would guess that it is likely dividend growth outperforms over the next 10 years. And we're going to have to keep validating that. But certainly it appears to be the case. And if things get difficult, we certainly won't be shy about playing defense. Moving on, the other inflation-oriented asset is commodities. And it does look like we are getting going in a second wave higher in commodity prices. Gold prices did pull back a little bit over the last month. Put it in context, we don't go straight higher. But the fact is we haven't exceeded the lows from last month. And my guess is we're into some support here. Commodities versus bonds, inflation-oriented asset versus disinflationary asset clearly is outperforming. So the two asset classes that we think make tons of sense are equities, and in particular dividend growth. That continues to play out. And then commodity-related securities, all of these things are things that can be priced higher tomorrow if inflation is up today. And then finally, Bitcoin. Bitcoin does continue to act pretty well. Did pull back over the week. It got as high as, I think, 99,000 on the weekend. It's 92,000 today on the close. To put it in context, we track this the same way we track all securities. We want to see higher highs and higher lows. And at this point, that's what we see. So we'll watch. This is the IBIT ETF that tracks Bitcoin. So look, we don't have to be everywhere. Our job is to try and focus on leadership, things that are working in the current environment that are seeing net new dollars get put to work. We're always watching for change, old leadership to recede or new leadership to emerge. And in the absence of leadership, be willing to hold some cash or be out of certain parts of the market. This is about being tactical. We are into the seasonally strongest period of the year. We got an election and some uncertainty out of the way. We've got a strong backdrop coming in. So when we look at our top-down work, which top down, understanding the market environment that we're in is 70% of return. Our job is to try to identify those themes that are outperforming and have strong relative performance. They're seeing net new dollars get put to work. So ultimately, where we can find these areas that are seeing expanding breadth, more and more securities participating in the rally, that's where our focus should be. In the bottom up work, we're trying to look at all the securities that we could choose from that are liquid, that are high quality, that meet our fundamental tests and our technical tests. And we're going to try and identify a basket of securities that we could own if they were in the right area, where we can find securities that line up in parts of the market that are seeing net new inflows. That's where our portfolio should live. And then the last piece is we have to be really disciplined around being willing to exit. And that's where our selling strategy comes in. When we see deteriorating breadth, or we come down and hit one of our stop losses, we raise cash, right? We tighten up our stops and we stop putting new money to work. So this is a wash, rinse, and repeat process that we go through every day. We're trying to examine every position we own every day through this set of lenses. And then ultimately we report back in these weekly webcasts. So as we sit, the breadth data for the equity markets themselves is solidly positive. When we track the percent of stocks in uptrends in Canada, it's been expanding. In the US, it's been expanding. Globally, it's been expanding. Now you can see the US has the highest percent of stocks in uptrends. It has been the strongest market. When we look under the surface at the percent of stocks trading above the 50-day moving average, US is pushing up against 70%. Canada's pushing up against 60%, but the number's green, it's rising. So more and more stocks trading above their 50-day moving average. Percent of stocks with positive weekly price momentum. After a 2-week pause, we've seen a reacceleration in the percent of stocks with positive weekly momentum. Percent of stocks making new highs versus new lows continues to rise. And as a longer term indicator, the percent of stocks trading above their 30-week or 150-day moving average is also moving higher. So sometimes when markets have been strong, it's easy to worry about what happens later, like have things become overdone. Things I take away. When you're in a true bull market, you can get to the point where 80 or 90% of companies are participating, right? When everything's going up. That is not the case currently. It's getting better, but it's not the case. Certainly, we're seeing expansion and breadth around the world. That's great, but these indicators are not at the high end. Percent of stocks above the 30-week moving average can get darn close to 100%. So we're watching. So when we boil down into the underlying themes, there are some constants. Really, over the last 2 years, financial services just continue to chug along. It's a very long-term chart, but I put it up just to put it in context. Against the backdrop of a bear market that went on from 2000 to 2021, 2007 to 2021, 14 years, the fact that we've got 3-4 years where the sector's moving higher tells you this is an early stage bull market. When we talk about some of the leaders, JP Morgan that made a new all-time high in 2013, 7 years before the index did. It continues to chug along. Just yesterday, making a new 52-week high. Bank of America and the other large caps trading better than 87% of all the companies in the S&P over the last 52 weeks. So these have been leaders. The bank index itself, if you just look at the equally weighted index, which includes all of the banks, is making a new relative high versus the S&P. That's really healthy. And I want to put it in another context. If you look at the bank index relative to the S&P 500 from 1990 to present day, you would see from 2007 until 2023, it was a relative underperformer. And it's only just in the last 18 months started to show relative leadership. Now, why is that? Well, first of all, there has been some inflation, and inflation gives them an opportunity to have pricing power. We've said in a world of rising rates, the power is in the hands of the lender to get a spread between the deposit rate they pay and the loan rate they charge. But on top of that, we're now talking about deregulation. I thought this was a great chart I came across. Looked at the number of economically significant rules by month 40 of each presidency. So in blue, Biden, in green, Obama. So two Democrat presidents going back to the financial crisis, where the number of rules and regulations that have been put in have been significant. Now we know that the Republican administration is talking about deregulating. Well, when we think about deregulating, it shouldn't be a surprise that the investment banks have had a great run up in the last 2 months, but they've been outperforming now for a year. So on the back of a decent environment for deal making, it looks as though perhaps it's going to get better. Goldman Sachs, another significant name, gapping higher on the election and holding those gains, trading better than 90% of companies in the S&P. Let's go back and look at the bank loan growth. Why is it maybe they underperformed over these many years? This is pre-Great Financial Crisis loan growth, typically ranging between 5 and 10%, with some exceptions. In the period of Dodd-Frank regulation, very sluggish loan growth. And as we have come out of the pandemic, basically 0% loan growth. So lots of room for improvement here. And that shows in valuations. This chart shows the difference in the price earnings multiple, or the number of times earnings the market is willing to pay, with the S&P trading at 22 times earnings and the bank index at 12 times earnings. The difference between the two has been widening over the last decade, which means there's lots of room for bank valuations to try to catch up. So this group is not expensive, even though it is outperforming, and there's a long way that this can go. Now, over the last few weeks, we talked about what happened in the period after the 2016 Trump election. The regional banks relative to the S&P outperformed, and the mid-cap and small-cap stocks relative to the S&P outperformed. As we look at the KRE, which is the index of regional banks, you can see we have made a new high. And we are making a relative strength new high after underperforming the S&P for 18 months. So really, we are mirroring the same experience. Post-2016 in red, post-2024 in blue, 12.5% versus the S&P in 24, 13% versus the S&P in 16 in the first 14 days. So the regional banks continue to chug higher. This is the last 2 months of MTB's performance relative to the market. Same with Regions Financial. These are the two large positions that we put on. They're the two largest regional banks. So really, we're seeing strength across the financials. We think that they are relatively inexpensive relative to the market. There's a long way that they can be revalued. And this is in a world of 0% loan growth. If you see deregulation and a pickup in loan growth, more akin to what we saw before the financial crisis, there's clearly upside to the earnings. So if you can get rising earnings and a rising multiple, you get share prices that can go up a lot. And we're certainly seeing strong performance in the Canadian banks. Insurance continues to be strong, made a new relative strength high this past week, another strong week for financials. So all in, financials continue to perform really well. And even some of our big favorite insurance companies like Fairfax and Progressive made new highs this past week. So nothing changing here. On industrials, after a little pullback after the election, to test this gap we talked about last week, they powered higher again this week, made a new relative high. So the waste companies, Waste Connections and GFL both had great weeks. These are tightly tied to economic data. More economic activity generally leads to more waste. So this is a pretty good tell on the US economy. Caterpillar came back and is very close to making a new 52-week high and trading better than 84% of companies in the S&P. So industrials continue to do well. And then there's the transports within the industrials. Transports have gone a long time without making a new high, and recently just have. In fact, 756 days before making a new high. And again, we know that when they go a long period of time without making a new high, and eventually they do, it generally leads to a run-up in price. The engineering companies and companies selling into the infrastructure space after pulling back last week had another sharply higher week. Materials, after pulling back, started moving higher this week. The metals and miners making new highs. And the golds, after pulling back, have started to firm back up again over the last week. So certainly no problems here. There's Cameco, the producer of uranium, and the company that bought Westinghouse nuclear business. When a company goes sideways for a long time and it makes a new high, generally it's important. And we think that even though things are getting better, it's the very beginning. We think it can go on a long time. So lots to talk about. Now on energy did pull back today. We had a good sized weekly pullback. This is the equally weighted Canadian energy producers. Our guess is we're going to see some stabilization here. I think it's unlikely that the Republicans would put a significant tariff on Canadian energy. I think that unless they want to ride bikes down I-75, they're going to need it. Clean energy continues to be sloppy. And we have seen a nice pickup in consumer discretionary. So this is a group we may have to take a closer look at. We don't have tons of exposure here. I think it is relevant that consumer discretionary, which is discretionary relative to consumer staples, has outperformed nicely since the election. That tells us that, again, investors are making a bet on a stronger economy. Costco Wholesale is the biggest company that we have in the consumer space in the US, and it's been a great holding over the last year or so. Communications, making relative strength and absolute new highs. And that rounds out the strength. Healthcare has generally been an underperformer, not looking a whole lot better. Technology really has been a relative underperformer since June, although there are some pockets of strength. Software is the strongest part, made a new high this week. Constellation Software is our biggest holding in this area, made a new absolute and relative high, and semiconductors continue to underperform. This is one area that is a concern for me. We are now down to one holding in the semis, and that's Nvidia. I do think this chart is relevant. Gold outperformed semiconductors all the way through the 2000s, and then underperformed semiconductors until recently. This could be an important inflection point and something certainly worth watching now. Frankly, we have more gold exposure than we do to semiconductors, but this is why. So Nvidia's response after the earnings, a little bit weaker on a relative basis versus the market, still trading largely above the 50-day moving average and the 200-day moving average. We're going to have to continue to assess this. So when we put it all together and look at these groups, we're progressing. On average, the percent of stocks in uptrends across sectors improved by 3% this week. We know there's a bunch of groups that are participating. A lot of the groups in the financials are the strongest: insurance, banks, regional banks, and Wall Street. They have the highest percent of stocks in uptrends. We saw some good improvement in home builders and in machinery, that's industrials. Software has been showing some improvement in computers. And at the other end of the spectrum, healthcare and small letters continues to see weakening breadth. Healthcare, biotech, drugs. Semiconductors is notable for its weak breadth and relative strength. Consumer staples, relatively weak. So it's a mixed bag. But what is really bullish, in my opinion, is there are a lot of themes that are participating in this market, and we are not in a market that is driven by just the 7 biggest companies. When we go back over the last 18 months, equal weight S&P is up 39%. The All World ex-US Index is up 23. Our equity strategy is up 45. Our income strategy up 37. Our macro strategy up 28.3. And our global equity fund up 39.4. I think these things are working pretty well. From a sector perspective, financials are by far our biggest weight, and they continue to grow at 28%. We don't think we're out over our skis here with a 10-point difference in valuation between the S&P and the financial sector. We think it's very inexpensive and continues to be underowned. Industrials weight continues to grow, but more of our focus in industrials is in the US. Energy is an important overweight and one that we're going to have to watch closely, but the long-term charts look good because these companies generate a ton of cash and can raise price tomorrow when their costs go up today. Tech has become a really significant underweight. Communications has grown a little bit over the last couple of weeks. Consumer staples a little bit, but still an underweight. And then you can see healthcare, real estate, consumer discretionary, utilities, an underweight. It really is more offense is where the strength is, and defense are parts of the market that are underperforming. So what do we think about from a risk perspective? Breadth is improving. Equity market investors clearly are bullish. When we look at credit investors, the excess return they are demanding to take credit risk in either an investment grade bond or a high yield bond has been weakening, which means they don't think that there are credit problems on the horizon. Volatility is solidly in the range that it has tended to be in the best of the equity bull markets, and in fact, below normal. And there's no sign of any kind of topping process in the S&P. Now, lots of folks have said, market's been good. Should we be worried about a correction? I've used this highlight. When the market got to 2 years in a bull market without a significant correction, it tended to go on for a long time, 5.5 years. This is the length of the current bull market compared to previous bull markets, which have gone on a lot longer. We talked last week about when the return has been strong, getting to November to December. Generally, December tends to be pretty strong, and that looks like it may be the case. We're about to get there and see. But I thought this stat was an interesting one. When the market has been up 20% 2 years in a row, should we be concerned? So in 1995, which was the strongest year prior to this year, at this point in the year, it had been up 37% and 22% in 95 and 96. 1997 was up 33%. Now, what's more is that when 96 and 97 were both strong, 98 was up 28%. And when 97 and 98 were strong, 99 was up 21%. You can't be afraid of a bull market, right? There's a reason why we've been doing these webcasts every week, to try to give people confidence to know that there is opportunity in front of us. 2020 in the COVID was very difficult, as was 2018. But we're in a different market here today, and it looks as though things continue to be quite constructive. Good years come in bunches, and we think that we're into one of those periods. If things get more difficult, or our breadth models change, we'll get more defensive. If sector themes start to roll over, or our stops start to get hit, we'll wind up with cash. But as it is right now, the opportunity set, whether it's in US equities or Canadian equities or global equities or in commodities, the opportunity set to protect against inflation is there and doing what it should be doing given the environment I think that we're in. So with that, we'll answer any questions. Please don't hesitate to follow us on Twitter in between. We post some stuff over the course of the week that I think is useful, and certainly happy to answer any questions. So Jerry asks, how would we compare the outlook for US banks versus the Canadian banks over the next 12 months? Well, I think that that's a fair question. Let's just see if I can throw up a chart here. Let's do it this way. So if we look at the equally weighted Canadian banks, there we go, ZEB, you can see that we're just making new highs. New highs we haven't seen since 2022. US banks are leading, although from a relative perspective, over the last 3-4 months, Canadian banks are performing pretty well. It really comes down to the banks you're looking at. RBC, which is leading in wealth management and capital markets, has been making new highs now really since June, and that's been one of the core leaders. National Bank, which has very strong organic growth, has been steadily making relative new highs. If you're looking at something like TD, which is in some difficulty in the US, it clearly is not. So you have to pick your spots. All the Canadian banks are different. I do think that we've been adding more to the US because deregulation is likely to help them become more productive. So some of the regional banks we think look quite interesting, and some of the insurance companies look pretty good as well. How are you playing the transports? Yeah, we have not got a lot of exposure right now in the transports. We certainly have been looking. Trucking in the US is one of the areas that looks most interesting. We do have some logistics exposure through Element Fleet and through Descartes, but on the absolute transports themselves, we don't have lots of exposure right now, but certainly an area that we can look at. From an anonymous person, where can a person find information to help understand the sectors and various companies that fit into it? This is a lifetime exercise to learn. And one of the things that I love about this business is we get up and learn every day. My kids like to laugh because I probably have in my head 2,000 or 3,000 stock symbols. This is lots of information on the internet. One of the places that you can look is when you look at a specific ETF, it's very easy to find the holdings, and generally the largest companies are weighted biggest within the ETFs. If you're not interested in doing it on your own, certainly we can help with that. But lots of sources of good information. If you ever want to reach out, I'm happy to point you in the right direction. Let's see if we got any more questions. I think that's it. So the 26th of November, for all of our American friends, please have a wonderful Thanksgiving. And we'll look forward to a productive December and look forward to a new year. So thanks very much for tuning in. We'll see you again next week.